in here Rob McLister, founder of RateSpy.com, for reaction from the industry side. Rob, this is unusual. This is the kind of thing obviously happens in the background. This wasn't a public statement. It was a letter from CMHC to the banks. But just in terms of your overall reaction about the fears being expressed here, what do you think of it?
Well, first of all, when you put a letter like this out to 100 plus lending institutions, it's bound to leak. So you might as well just put it out to the whole public. And that's, Mr. Siddall did that after it leaked. But anyway, there's so much here that was left out. So if you're a layperson looking at this, you're like, oh man, like there's so much risk in the housing market. We got to tighten up right away. I'm writing my MP. The fact of the matter is that debt ratios are high because of two main things. Number one, CMHC and policymakers dropping the ball with respect to generating housing supply. There's not enough housing supply for middle-class Canadians who need houses, period. And we've known about this problem a long time. Number two, the debt ratios are high because they're being stress tested. If you get a 1.99% 5-year fixed mortgage, which is par for the course these days, you're being forced to prove you can afford a rate 280 basis points above the actual rate you pay. That is unrealistic. It's unnecessary. That's why debt ratios are so high. You got someone that's got, a gross debt service ratio at the limit, 39%. That person's real effective gross debt service ratio, if you use the actual rate they pay for 5 whole years, is below 31% in some cases. And so just to put that in perspective, 32% is a typical accepted norm for conservative lending.
Just the concern that Siddall is raising and that the regulator's raising is that as they lose their stabilizing market share here on the insurance side, there is a scenario where house prices fall. He thinks it could happen, he notes, towards the end of 2020, and that there are loans being offered that are effectively negative equity. Is that not a legitimate concern? I mean, is the premise that we're okay based on the idea that house prices continue to be stable or go up?
Yeah, so I've written a lot about how folks that are putting only 5% down, that have very high debt ratios, that don't have a path to higher income, should not be getting 5% down mortgages. So, on day one, you're somewhere around 99% financed with that insurance premium. So if house prices go down even a little, you're underwater. So I'm sympathetic to that point. But the fact of the matter is, we've got decades and decades of data. Insurers and lenders know with high certainty how likely someone is to repay their mortgage. So these, quote unquote high debt ratio mortgages, specifically the ones that CMHC no longer underwrites, perform extremely well for the private default insurers. As well or better than CMHC's mortgages. CMHC's loss ratios, by the way, were much higher than the private insurers in first quarter. So, the private insurers here and lenders in general are doing something right.
I guess the point that I think he's making, and it sort of asks the lenders to consider something that's beyond their own purview, right? Their purview is the risk return of their mortgage book and the profitability of their bank or their institution. He's saying somebody can pay back their mortgage. The mortgage may never default, but if it's too large, if their debt to income is the wrong ratio, they won't be able to buy anything else. They won't be able to spend anything else, and the whole economic drag effect happens. Should banks, should lenders be asked to consider that question?
Well, that's not so much a lender concern. That's a policy concern. The government needs to, we're allowing 300,000 plus immigrants in the country every year, and they add a tremendous amount to our economy. It's good policy, but you need to house enough people with that kind of inflow, the urban migration. You need to house people with new supply. You need to invest in transportation to take people from high-cost areas to low-cost areas where they can afford a home. These are the much bigger problems that CMHC needs to fix, as opposed to the Band-Aid solutions of tightening up, demand at the margins.
Are you concerned about the number of Canadians, though, who may be in over their heads? Those stress tests may seem extreme, but there are scenarios, right, where we get runaway inflation because of the record amount of monetary easing. We don't know. Nobody thinks it's going to happen soon, Rob, but it could happen, right? Should we not be ultra conservative on that side of things?
100%. And so I think that as it stands, insurers and lenders are being extremely conservative. Nobody wants to take a house back. Nobody wants to see, these regulators monitor lenders every day with a microscope. No lender or insurer wants to lend such that their arrears rate is noticeably above average, because then they stick out and bad things happen. Cost of capital goes up, regulators clamp down on you. There are so many incentives that people don't understand in this business to keep lenders doing the right thing. People equate it to the United States situation back in the housing crisis in 2007-8. It's night and day different how things are run up here in Canada.
All right, we're going to leave it there, Rob. It's great to have you with us. Rob McLister is the founder of ratespy.com.